in the country, and that is we are going to have a quick conversation on foreign exchange. What has happened to bring us to the state or the situation that we are in today? What are the challenges going forward? Who are the winners and losers? And what is the outlook for currency exchange as well as foreign reserves as we move forward over the next couple of years? So let's start by taking some sense of the situation analysis and what's been happening. We will talk about the dynamics of the foreign exchange, and we will speak to those who already have US dollars, some of the things that you can do to increase or enhance your returns at the end of this presentation. Let's go now to what's been happening in the foreign exchange market. Well, since towards the end of 2015, we have seen a situation where the currency between 2015 and the end of 2016 has drifted downwards, and thereafter into 2017 has stabilized. This graph that you see shows that situation and shows that the currency has depreciated since the end of 2015 until now by some 5.3%. Let's look at what has been happening in terms of currencies internationally with energy/oil exporting countries. What you would see in the graph that is before you is that some countries have had significant depreciation of their currency. Nigeria, for example, 54.8% depreciation. Angola, 54.2%. African countries. When you move to Eastern Europe, Kazakhstan, 42.7% down. Whereas WTI, West Texas, is down about 40% over the same period. Then as you move to Russia, some 39.5% deterioration. Brazil, in the Latin American space, 31%. Canada, in North America, 16%. And Kuwait in the Middle East, about 6%. That compares to our position where through a process of currency management or managing the currency, the exchange has depreciated just about 5.3, which is the lowest amongst comparative energy exporting countries. So what does that mean in terms of the reserves and the import cover for these countries? What you see is that in the case of Canada, for example, the reserves or the import cover stands at some 2 months. The highest import cover is that of Brazil, some 17 months. And Trinidad and Tobago is reasonably well placed, somewhere at about the middle of the pack, being some 10 months of import cover. Compare that again with Russia at 13 months, Angola and Kuwait at 8 to 9 months. So we are reasonably well placed with regard to import cover. And in terms of our reserves to GDP, what you are seeing in terms of reserves to GDP is that our reserves to GDP is about 45%, whereas other players, Russia being in the middle, Angola 25%, and some other players where it is somewhat lower. So we'll say the lower, the better in terms of the percentages. Now let's look at what has been happening here in Trinidad and Tobago with regard to the buying and selling of foreign currency. When you look at the middle of this particular graph, which is 2015, what you would see in 2015 was that the sales to the public of currency was the highest it has been in terms of the records that we show on this particular graph going back to 2013, some $7.4 billion. And Purchases from the public also would be, in that year, $4.9 billion. And it was a year of superlatives for the central bank in that it was the year in which it provided to the market over this period, 5-year period, the highest injection of currency. What has happened since 2015, as we take a look on this graph? 2016, very significant fall off in sales to the public. And that ties in very well to what has been the earning power of currency in the country, which we shall come to in a minute. And we can see as we go along the sales to the public that that figure has actually been falling from a peak in 2015 of 7.4 billion to 5.8 and then 5.2. And let's see how it is going to go in a full year 2018. But the trend is clear that sales to the public have been falling, and all participants in the market would have already felt that in their pockets and in their coffers with regard to access to currency. Now, let's look at what will happen with purchases from the public, which is a very important indicator. Public being anyone who wishes to sell to licensed dealers, that is, the banks in Trinidad and Tobago, their currency. And what we would have seen in 2015, again, this benchmark, sales, or shall we say purchases from the public by licensed dealers, was just about $4.9 billion. And the rest was made up in terms of the sales to the public, that $2.6 billion injection from the central bank. What has happened since? What we have seen is the fall off in terms of the sales to the public, concomitant with a fall off in export earnings. What we have seen in terms of the purchases from the public, because export earnings have been falling and therefore currency inflows have been falling, there is that fall off in terms of purchases from the public. Less is being provided to the licensed dealers from the public. And what we have, the making up of the difference by the central bank is 1.8 billion in 2016 and then another 1.8 billion in 2017. So that's the situation as it stands now, and this is what in a sense accounts for the challenges and the dearth of foreign exchange available to the market. So what is the situation with regard to official reserves, net external reserves, and import cover? Participants would be aware that import cover really represents the number of months of import that can be supported by the foreign exchange official reserves. So if we look back from the beginning of our chart in 2013, we've seen that by 2014, net official reserves would have reached the highest in this pictorial representation to the extent of $12.9 billion. And those reserves would have fallen away over time as the central bank continues to provide injections into the system, as well as being impacted adversely by the fall off on foreign currency earnings. So that by 2015, you would have had 11.2 months of import cover. That is, the reserves could support another 11 months or so of imports. And at that time, the net official reserves was $9.9 billion. The trend line here shows you that the cover has been falling and the reserves as well have been going in that same direction. 9.9 in 2015, 9.5 in 2016, and 8.4 in 2017. So the challenges continue to persist with regard to the currency story. Now, just to show you that the foreign exchange or the foreign reserves have been buttressed to some extent in 2016 and 2017 by the drawdown on the Heritage and Stabilization Fund. As you would see on your screen, in 2016, there was a drawdown of 375 million US dollars from the Heritage and Stabilization Fund. This would have contributed to the reserves being an injection into the reserves of this 375 million US dollars. And then again, in 2017, you would have seen a drawdown on the Heritage and Stabilization Fund, which is a US dollar denominated assets held for the purposes of stabilization and for generations to come, drawn from the largesse over time that we would have generated from energy prices. And so this is the story where we are at today. What has been happening, we'll talk next about what is happening what are the drivers of exports and currency earnings for the country, and where can we draw otherwise in terms of the Heritage and Stabilization Fund to generate additions to the reserve. So let's look at the currency drivers now. And what you are seeing, of course, the main currency driver is energy. Energy has accounted over time for between 80 to 90% of export earnings and therefore foreign currency coming into the country. And so you will see in terms of what happens in energy impacts very significantly what happens to currency and reserves. Let's take oil production, for example. When oil prices are high, with increased production and increased prices, you will get an increased flow of currency in terms of export earnings. So if that is the case, let us look at what has been happening with production. At the bottom of your screen, what you will see is that the oil production has been falling. So much so from, let's say, 2014, you would have had 29.7 million barrels of oil being produced. And that has fallen away by 2016, 2017 to about 26.2 million barrels of oil per annum, translating into some 70,000 to 71,000 barrels of oil per day. Now, apart from production, the other part of the equation, what is happening with oil prices? And you can see on your screen, oil prices, average oil prices, WTI, which is our benchmark oil price, has been falling from $97, $98, and by 2015 had fallen to $48.7 per barrel. And even worse, in 2016, where the average price was $43.20, and has picked up somewhat in 2017, where the average price is $50.90 or thereabouts. We know at today's prices, over the past week, WTI has been in the vicinity of 61 to 63, depending on which day of the week or past couple of weeks you have been looking at that. So in terms of contribution of oil, with production falling off and prices starting to stabilize, but at a much lower level, the contribution to foreign exchange earnings has fallen away quite considerably. So let's look at the other part of the energy equation, which is natural gas. Natural gas production has been falling. And what you can see on your screen is whereas in 2013 we were producing 4.1 billion cubic feet per day, it has fallen to 4.0, and in 2015 it was 3.8, fallen even further in 2016 to 3.3, and stabilizing there notwithstanding that there have been very strong initiatives to enhance gas production, whether it be by way of truck, whether it be by way of juniper or other measures, stabilization is taking place at a much lower level, somewhere in the vicinity of 75 to 80% of what the peak was, filling capacity requirements at about that 4.1 billion cubic feet. So we have a fall in our other major input to currency earnings, which is natural gas, and that fall is by close to 80% or thereabouts. Let's look at LNG. What has been happening to LNG? And I chose LNG because LNG has been in the order of, it utilizes in the order of 45 to 55% of our gas production in normal times. And what we have seen is that LNG production has fallen off again quite considerably when you look at what is happening in terms of millions of cubic meters, what has been happening to the LNG production. This is the fall, and we are now here at about 25 odd million. So, notwithstanding this, the nadir of LNG prices was on a weighted average basis some $5.69 per unit. And it has, over the last 2 years, increased at a reasonable clip, as you would see, 649 and 706. Yet still, on a weighted average basis, that increase in price has not been able to compensate for the decline in production. Decline in production being caused by a rationing of gas, which, as we showed you, production of gas, which feeds into LNG and other petrochemical products, has deteriorated to the extent of 75 to about 80%. So all of these factors combined now takes us into a place and brings us to this situation where we are now, where export earnings have been falling. I am giving you, of course, the specifics as to why and where that shortfall is taking place. So here is where we are now with regard to Trinidad and Tobago position with exports and imports. And this graph shows you exports and imports of goods, and below the line, the net negative of services in the foreign exchange story and the export and import story. So, for example, in 2014, you would see here total exports of goods at 15 billion US dollars and imports at 8.6. While imports have remained sticky at this level, 8.6 billion, going up a bit in 2016 to 9.4, what you are seeing is that exports have been falling drastically from 15 billion in 2014 to 11 billion US to 8.2 billion US, and we are at the half year in 2017 down to 4.8. This is for the half year, and if we smooth out, it should be a little bit closer to about 9 point something. So this is the story with regard to export imports, and of course the blue line below here shows you the net deficit in services, that is export less import of services, resulting in a negative position in each case. Let's now ask ourselves the question, within the context of policy, which is at the current time to hold, and has been to hold, the official rate at the $6.75, $6.80 figure. Who are the winners and who are the losers? in this zero-sum game. Winners are those who, whether for trading or manufacturing purposes, are receiving a greater proportion of their need for currency at the official rate. So what this table shows you on the far left here is that if you were, for example, getting 75% of your need at the official rate, and you had a markup of 50%, what can we expect that is happening? If the cost of the official rate is passed on to the investor, then you will see that essentially the great winner would be the importer of goods. The importer of goods will get his margin on goods and services, but will then also get a margin related to, let's say, the replacement cost or the deemed replacement cost of the goods. Meaning that if it is considered that the replacement cost is at the unofficial rate, and we'll come to that in a minute, what is the unofficial rate? If it is considered that the replacement cost is at the unofficial rate, the importer will get two benefits. One, the margin on the goods and services, but two, the margin between the official rate and the unofficial rate, which is a currency gain. Now, there is need for more explanation of this particular graph, but it will take much time to go into it. The bottom line is that if your weighted average cost weighted between the official rate at which an importer can access currency and the unofficial rate, which may be in the order of $8 to $8.50 or thereabouts, then you are seeing where the benefits, if they are passed on, will be. There is the concern that the consumer at the end is paying the full cost of the replacement rate. In other words, the consumer is paying at what we would call the unofficial rate for goods and services. So let's take a look at the whole question of the factors impacting currency and how they will feed into the outlook going forward. We've already pointed out that a major factor on the supply side is what happens with energy production and what happens with energy prices. On the oil side, what has happened is even though prices have gone up, there is a question for the producers of the additional supplemental tax that they would have to pay once the price of oil goes on average above $50. If you're onshore, the supplemental tax is 18%, and if you're offshore, it is about 33%. On the demand side, of course, there have been numerous reports about the extent of credit card purchases. Now, the reason for that, of course, is that the credit card purchases in US dollars is at the official rate. Why would the rational purchaser decide to buy goods and services from retailers and distributors at what might be the unofficial rate, when if they have access, they can go on and buy through their credit cards their import needs and therefore benefit from it. So in some cases, the consumer can benefit depending on the route that the consumer takes and if that route is available to the consumer via credit cards. It is well known that the import of goods accounts for about 40% of GDP over the period January to June 2017. But there are persistent shortages. When consumer goes to the bank, it is well known, you ask for $500, you get $2, or maybe even less, and you are told to come back another day and so on. So this shortage is creating some level of confidence concerns in the economy and in the system by those who are the utilizers of currency, whether consumer, whether trader, or otherwise. This is the challenge. Of course, it is having an adverse impact on the economy, because if businesses cannot find currency to continue with their operations, you are going to find a fall off in business activity, economic activity, employment, and the list, of course, goes on. Of course, some of this can be mitigated by the continued drawdown on the Heritage and Stabilization Fund in terms of building up and keeping the reserves at a particular level. So let's now go to the outlook for the currency, and let's take the outlook from an official international perspective. That is the IMF 2017 Article 4 consultation in Trinidad and Tobago. And clearly, what the consultation revealed in terms of the estimates of the IMF is that the real effective exchange rate is in the order of 20 to 25 to 30%. This is using end of 2016 figures. Translated, what does this mean? It means that the currency depreciated 25 to 30% would be in the order of about $8.45 and up. And what is the reality on the ground? Setting aside these methodologies for real effective exchange rates and so on, what is the reality on the ground? The reality on the ground right now is that currency has been traded in the unofficial, or as some would call it, the black market, at a rate in the order of $7.50, $8, and in cases $8.50. So that is the reality. The reality is that we are seeing more and more of this exchange in an unofficial market, that is bypassing the licensed traders who are the banks. So let's talk a little bit now about you as an investor. What can you do with the US dollars that you have in your position at this point in time? Well, let's look at what happened in 2017. US dollar savings accounts were in the order of a quarter of 1% or even less. US dollar income funds were in the order generating 1.5% tax exempt. Repurchase agreements being offered in the market would be in the order, or would have been in the order of 2.5%. In 2017, bonds, emerging market bonds that were investment grade, generated total returns of 7.2%, and emerging markets were high yielding, that is speculative grade, generated 9.5%. Again, in US dollars, the equity market, the world index, provided a return, or weighted average return, of just about 20%. Now, having said that, historical performance is not necessarily an indicator of any future performance. But what you need to do as an investor, risk and returns be taken into consideration, is to look very carefully at what are the opportunities that are there for you to maximize and make your US dollar work better for you. Holding it in the bank at this point in time will provide, as I suggested before, the lowest returns, and did in fact provide the lowest returns in 2017. What can we expect as we conclude this presentation? Well, there will be continuing challenges in accessing foreign exchange. because I have shown already that there is an imbalance in terms of earnings and or inflows of currency and the utilization of currency. With government having its hands on the tap of the reserve, it means that through or via the central bank, there is a tightening because of the release in terms of the shortage or shortfall of import needs in the country and the need for currency. So let's look at this graph, and what we will see is that over time, as I've shown before, that the reserves have been falling. And we are here today at the end of 2017 going into 2018. And therefore, what we see is that if we continue all other things being equal in the same trend, and you have a drawdown on the reserves in the order of $1 to $1.1 billion, we can see that our import cover will fall from the 9.7 in 2017, our estimates, to 8.5 months to 7.3 months, and will get down to that magical figure, that target figure, or that benchmark figure of about 6 months by 2020. That's one of the things that you can see happening in terms of the currency. The approach of maintaining the official reserves at a certain level has created winners and losers. The main losers are the consumers. So that even though it sounds well to say that the official rate is at this level, the fact is that access to currency at the official rate by the consumer is quite diminished and very difficult to actually come by. This is what we can expect as we look forward over the next 2 years. Very little in terms of reprieve. There is the possibility that if the currency is allowed to float at or near the market rate, we can see that rate going up to $8, $8.50 and so on. But that is already the case in the unofficial market that is operating at this point in time. So there we are. These are the thoughts that we have, and we can open it now up to questions that you may have with regard to the currency or any other questions, if possible. If I cannot answer at this point in time, rest assured we will pull the statistics so that we can answer it. Let's go to our first question. Will oil prices holding above $60 per barrel increase foreign exchange flows to Trinidad in the short term? Well, there are a couple of factors that impact what's happening with regard to the inflow of currency. Yes, in theory, $60 should bring in additional currency, but there are other issues in the energy sector, some of which include the fact that there is a significant tax loss carried forward by many of these companies. The take on the fiscal side has been lower. And also, because of the fact that you have somewhat higher energy prices, that is mitigated by the reduced production since 2014, since 2015. So it's not an easy equation, but I think that we are at the very best level pegging, but in practical terms, as I showed in the last graph, the currency and the reserves likely to fall away still somewhat. Next question. Does Bourse offer investments in some of the higher performing global EM products? And the answer is yes. Certainly on the bond side, we offer that, and we expect to be offering the opportunity, together with advice, to participate in the equity space, which we showed last year was probably the highest return. But as you can see, what is happening this year, there is increased volatility in the equity space, and therefore one has to approach that equity space with great care. However, in the bond space, opportunities still abound for investors who are interested in buying and holding out to 5-6 years, as the case may be. What should the rate, next question, what should the rate be adjusted to? Well, our view is that the quicker we move towards or near to market rates, it will allow the economy and the system to adjust to a level which positions it to the next takeoff. As it is now, the policy framework does not provide for this, and we will continue to see essentially subsidization in several forms and shapes, and subsidization is not something that is going to allow us to get to a market level which creates the next levels of efficiency that might be required for the economy to get its bearing and take off again. Next question. How can I invest in the equity space? Well, give us a call and we will share with you our approach at Bourse to participating in the equity space. That is not to say that you cannot participate in the equity space without necessarily participating in direct holdings of shares and so on. The opportunity exists for you to invest in equity and equity-related mutual funds that are available in Trinidad from various providers, including Bourse, to be able to participate. If you are a smaller investor, the mutual fund space is actually the better space for you to invest. If you are at the middle level, we would encourage you to move towards direct investment. And of course, the higher level players do already participate in direct equity investments. Next question. How would adjusting the FX rate affect the poor man? Poor in inverted commas. Well, the real question that has to be answered is how much of the official rate, which is a subsidized rate when considered against the unofficial rate or the so-called black market, how much of this is being passed on to the consumer? And the perception is, and intuition suggests, that very little of this is being passed on to the consumer. In effect, what is happening, or what we perceive is happening based on empirical evidence available, what is happening is that the consumer is already paying the replacement cost, or is already paying for goods and services reflecting the unofficial rate. So who benefits in terms of getting the benefit of the official, or interpolating between the official and unofficial rate? It seems to be more in the quarter of the trader. Next question. Since Trinidad and Tobago has a high propensity to import, wouldn't the higher devalued exchange rate cause hardship on the population? Well, I've already answered that question by saying that that cost is in the main already being passed on to the consumer and to the population. If there is an increase, this is the other question before me, if there is an increase in the exchange rate, how will this impact on current opportunities such as equity and bonds? Well, with regard to US equity and bonds, there will be no real impact as far as that is concerned. But if you are talking about local equity and bonds, that will be another matter. I would suggest, in terms, since we are talking about the US side of the equation, that the exchange rate will not affect the US dollar equity and bonds, because at the end of the day, we have to pay for US equity and bonds in US dollars. So those are some of the questions that have come across. I see another question coming up, and this has to do with Guardian Holdings. Is an offer like Guardian Holdings good for investors seeking foreign exchange? Well, you would recall that the Guardian Holdings offer, which has lapsed now, was at a figure per share of $2.35. And then the question was, if the market, the local market, was trading at $17 TT, whether someone was prepared to take $2.35. And in some cases, as we would have seen when the offer was open, it made sense to some players to buy or to sell their Guardian shares, or even to try to arbitrage by buying Guardian shares, accepting at $17 TT, accepting the $2.35 US. And what would have meant, it would have meant that the player would have had access to US dollars, which has been part of the difficulty in the system. But whatever the price, there is no access in the unofficial system to speak about. Next question, and this is related. Our view on the NCBJ takeover bid for Guardian. Well, I can only comment on the price. I would not want to comment on the other matters, such as the regulatory issues and so on, which are now before the SEC, which has commenced a hearing on that particular takeover bid. So let us see what is the outcome of that hearing as it continues. Have you had any recent information about the TTNGL dividends being paid in US dollars? Well, what we know is that provision has been made in the company's formation documents or constituting documents to be able to pay in US dollars. Let me share with you what my thought is. It might be a difficulty for the company to make payment in US dollars if it does not go and get some sort of a blessing, shall we say, from some of the significant owners of shares. And from a policy point of view, whether or not the government or the Honorable Minister of Finance, the corporation sole, will be supportive of making a US dollar dividend payment when shares were bought in TT dollars. Let's see how that goes. We don't have too long to wait to see what will happen in March, April. Can the exchange rate, this is the next question, can the exchange rate improve if the TT dollar is no longer set to float, or if it is managed? Well, we have shown what has been happening with regard to inflow of currency and the outflow of currency. And even if we, at the official rate, we are seeing a deterioration in terms of the reserve, I would expect that if the rate is allowed to go nearer to market, it will adjust some of the demand supply considerations for currency. And that may have an impact on whether the rate of deterioration of the reserve is mitigated. A positive impact, I would say. Next question, which I see on the screen, and this is the last question we can answer in this forum. Send your questions to us, and we will send you an answer over time, but not during this webinar. How can we access US dollars to purchase equity and bonds, given the difficulty to access funds? Well, there are certain legitimate ways that you can access US dollars, certainly at an implied higher price. And this is something that you might want to take up with your providers or with Bourse. So I think that's it in terms of the questions that we can answer within the time frame that is available to us in this webinar. I want to thank you as participants for taking the time to look into this question or this conversation on currency. If you have other questions, as I've said, we are prepared to share our thoughts and viewpoints with you. Just send them in, and our team will do its best to provide you with the appropriate feedback and answers in due course. Again, I want to thank all participants for joining in this webinar. This is Subhas Ramkhelawan, Managing Director for this particular webinar. See you soon.